Hi everybody. From a young age, we are told that it is very difficult to make money and that we should work hard our entire lives to earn and save as much money as possible. On the other hand, we see central banks all around the world printing huge quantities of money and that they have the power to create such precious thing without any constraint on themselves. Today, we will take a step back and try to understand from where does money come exactly, who has the responsibility and therefore the power to control the money supply in the economy, and what is the precise mechanism these institutions use to manage the money supply in the economy. If we understand the mechanism of money creation in the economy, we can develop a great understanding and many valuable insights into how our economy works, how financial markets operate, and what are the various underlying principles behind the movement of various asset prices. In this video, first we will understand what is the need of money and what exactly is money. Then we will understand the history of banking and the origins of fractional reserve banking system. Later, we will see the recent history of various monetary systems in the world. And then finally, we will understand the precise mechanism behind the money creation in our today's world and how not the government, not the central banks, but commercial banks are the ones who are responsible for the majority money creation in our today's world. In this video, we will focus on the United States because US dollar is the world reserve currency. But central banks all around the world operate in a similar way. I can assure you that in the next few minutes, we will learn some very fascinating and surprising insights about money creation, and at the end of the video, you will start to believe the insanity and the wonders of the world we are living in today. So let's dive in. There is a lot of research which shows that human beings are the most developed species on the planet, not because we are the most intelligent ones, but because of our special ability to coordinate with large groups of people. Human beings were able to make such wonderful progress only because we were able to move from subsistence economy, in which we would only consume what we produce, to exchange economy, in which we would exchange each other's produce. Imagine today if we had to grow our own crops by ourselves, build our homes by ourselves, treat our illnesses by ourselves. It would not have been even possible to imagine the great quality of goods and services which are at our disposal today. This is the power of specialization which comes from division of labor. For this exchange economy to function properly, a good medium of exchange is extremely necessary. Therefore, it is said that money is one of the greatest inventions of all time. Before the concept of money was invented, barter system was prevalent. But barter system was extremely inefficient. Because of this, people started to universally accept some or the other thing as medium of exchange. Historically, a lot of things such as cattle, seashells, etc. have been used as money. For an object to be categorized as money, it must have three distinct characteristics. First, it must be a store of value. It should retain its value over a long period of time. Second, it must be a unit of account. Every good and service available in the market should be able to be priced in this object. And third, everyone should be able to see this object as valuable and should be willing to exchange their valuable real goods and services with this object. Gold fulfills all these conditions very precisely, and historically it has been found that gold has been widely used as a form of money for the longest period of time. Let us understand the history of banking with the help of an story. With gold as a medium of exchange, trade and commerce grew rapidly. Everyone started to gain specialization in their occupation, which led to massive increase in the production of goods and services, and which led to increased quality of life for everyone in the society. With all this development taking place, there was an intelligent entrepreneur, Hirsch, who noticed a major problem faced by people around him. He saw that there were many people who had savings in the form of gold, but they did not have any safe place to keep their gold. People would often bury this gold in the backyard or keep it in their wardrobes, and therefore there was always a chance of robberies and thefts. Seeing this problem, Harsh came up with an idea. He built a huge building with a very secure locker in it as a place to keep gold. He employed security guards and took various other measures to ensure the building's safety. Slowly, the people in the society started to keep their golds in the vault to keep their gold safe. When people deposited the gold in the bank, they used to receive a receipt stating the quantity of gold they had deposited, and whenever people wished to withdraw their gold, they could just show the receipt and take their gold back. Some fees were levied on the depositors for providing this service, which they happily paid. Harsh named this building a bank, and this is how the business of banking began. This venture solved a huge problem faced by people, and therefore it grew very rapidly as more and more people started to keep their gold in this vault. With all the people keeping gold in the bank, Harsh noticed one interesting thing. He saw that there were some people whose gold would lie in the bank for a long period of time. These were generally the rich people with established occupations, and they had excess savings and didn't know what to do with them. On the other hand, there were young people with brilliant ideas and projects in mind which would develop the economy and make everyone's life easier. But these people did not have the capital to execute this project. So Harsh came up with an idea. He did an experiment in which he found one of the depositors in his bank, Ram, who had 10,000 coins deposited in the bank but did not need the money for a period of 1 year. He found another person, Sham, who wanted to build an irrigation system to supply water to the farmers. He needed 10,000 coins to build this project and a period of 1 year to turn this project profitable. Harsh came upon an agreement between Ram and Sham in which he took the 10,000 coins which belonged to Ram and were placed in his vault and gave it to Sham as a loan. Sham took this money and invested in his business, and he promised to pay the $10,000 of principal with an additional 100 coins of interest after the period of 1 year. After 1 year, Sham paid this money to Harsh, and Harsh paid this principal of $10,000 back to Ram. Out of the $100 of interest which Harsh received, he gave 50 coins to Ram and kept 50 coins to himself. This was a win-win situation for everybody. Sham got the capital to invest in his business, Ram got interest on his idle sitting money, and Harsh was able to make a profit for facilitating this deal. Harsh replicated this model with many of his depositors, and he found a great alternate source of income in the form of difference between the interest he charged when he gave loans and the interest he paid to the depositors to use their money to give out the loans. With this alternate source of income, Harsh was able to pay the depositors money to keep the money safe with himself as compared to earlier when he used to charge people to keep their money safe. This way, bank became the lenders to people who need credit in the economy. As time passed by, trade and commerce grew, and therefore the volume and complexity of trade and commerce in the economy also grew. Therefore, larger and larger number of gold coins were required to facilitate transactions. Due to the bulky nature of gold, exchanging huge volumes of gold became very inefficient, and therefore slowly gold itself started to become inefficient as a medium of exchange. As we saw earlier, whenever a person used to deposit his gold in the bank, he used to receive a receipt which was the proof of his deposit. This receipt was an important document and was made hard to counterfeit. Because gold started to become inefficient as a medium of exchange, slowly and steadily, what started to happen is that instead of exchanging huge volumes of gold with one another, people simply exchanged the bank receipts with each other, and whosoever had the receipt could collect the gold from the bank. Harsh started to issue these bank notes in the denominations of 10 coins, 100 coins, 1000 coins, etc., which made this practice grow even further. The receipt issued by Harsh had all the characteristics of money which we discussed earlier, and as this receipt represented real gold placed in the vault, people were comfortable to exchange this receipt as a medium of exchange instead of using gold. As trade and commerce developed and became more and more complex, the use of these banknotes also became more and more common. And there came a time when use of these banknotes was more common than use of actual gold. Our intelligent entrepreneur Harsh saw one more golden opportunity here. He noticed the widespread use of his banknotes as a medium of exchange instead of gold. As a result of people using these banknotes as a medium of exchange, he noticed that most of the gold in his vault was not being withdrawn for a very long period of time, and the receipt issued for them served the purpose of medium of exchange instead of gold. He made some very extensive calculations and came upon the conclusion that at any given point of time, no more than 10% of his total value of gold was required to meet the withdrawal request from his depositors. This basically meant that if there are 1000 banknotes issued in the economy, at that given point of time, no more than 100 coins would be asked by his depositors for withdrawal. This meant that Harsh could introduce 10 times more banknotes than the gold reserves he had in this vault, and still he would be able to run his bank seamlessly. Harsh used this opportunity very smartly. He printed a lot more banknotes than the gold reserves he had in his vault to back it. And he used to give these newly printed banknotes in the form of loan to people and charge interest on it. He only made sure that he had 10% of the total banknotes he had issued in the form of gold in his reserves to meet the withdrawal request from his depositors. This way, he was able to earn interest on a lot more money than he had gold in his reserves, and therefore his profits skyrocketed. This, ladies and gentlemen, is what is known as fractional reserve banking system. A system in which only a fraction of the bank deposits are backed by real cash and are available for withdrawal. Our current banking system is heavily based on this fractional reserve banking system, and we will study this in great depth later. In 1944, the turbulent times of World War II ended. Countries around the world realized that to bring back faster recovery and prosperity into the world, global trade had to be encouraged. Therefore, all the allied countries met in the city named Bretton Woods and came upon a new global monetary system. This system came to be known as the Bretton Woods monetary system. Prior to this, gold was used majorly as a medium of exchange for global trade, but using gold had its own disadvantages. Therefore, under the Bretton Woods system, the US dollar was chosen as the world reserve currency, and the US dollar was to be used as a medium of exchange for global trade. Further, all the currencies were tied to the US dollar for a fixed price, and the US dollar was tied to gold at a fixed price of $35 per ounce. This meant that all the currencies were backed by gold. This system worked very well for a great period of time. But then the US government started to increase its expenditure exponentially. It ran the Great Society program, launched various space missions, and was even fighting a war with Vietnam. To fund these major expenses, the US government started to run budget deficits and started to print more US dollar than the gold they had to back it. When this practice by the US reached new heights, other countries started to take notice, and then to secure themselves, they started to exchange the US dollars they had in reserves with gold. This led to massive outflows of gold from the US. To prevent this massive outflows of gold from the US government vaults, President Nixon in 1971 took the historic decision and suspended the convertibility of gold into US dollar.
The strength of a nation's currency is based on the strength of that nation's economy. And the American economy is by far the strongest in the world. Accordingly, I have directed the Secretary of the Treasury to take the action necessary to defend the dollar against the speculators. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States.
And the United States broke its promise it made under the Bretton Woods system. By removing the link between dollar and gold, President Nixon created a system in which all currencies were backed by nothing. This is what is known as fiat currency. Fiat currency means a system in which a currency is backed by nothing real but only government promises, and that the complete control over money supply goes into the hands of the government. Whenever there is the system of fiat currency, by some or the other way, currency devaluation, that is, the creation of a lot more money than needed, which leads to the decrease in the value of currency, is bound to take place. We will now understand how this money devaluation takes place in the current scenario. First, we will see the three different types of money used in the present system. First is the currency, which are the fancy pieces of paper and coins in your wallet. Second are the bank deposits. This is the money in your bank account which is reflected in your bank statement or your mobile banking apps. Third is the central bank reserves. Like we keep our deposits with the commercial banks keep their deposit with the central banks, and these deposits are known as central bank reserves. We will discuss bank deposits and central bank reserves in more detail. While going through the further part, you will feel that what I am trying to convey is completely wrong and is not at all possible. But among various other credible sources, I came across research papers published by the Bank of England which explains the phenomena in a clear and precise way. I will attach the link to those articles in the description box. In this video, I am just trying to explain those research papers. Today, majority of money devaluation is done by commercial banks. To understand how this is done, we need to understand two crucial points. First, we will understand what a bank deposit is. Whenever we think of money, we think of the currency present in our wallet. But in most developed economies, this currency forms only a tiny fraction of the money supply in the economy. Most of the money in the economy is in the form of bank deposits, that is, the numbers which get reflected in your bank accounts, and no, this bank deposits is not the same as the currency in your wallet. To understand how money is really created in our economy, first we will need to remove some of our major misconceptions about how the banking system works. Most of us see banks as an intermediary between people who save money and people who need loans. We think that the banks give out the deposits that savers place with them as loans. A little advanced understanding of banking includes the knowledge of the fractional reserve banking system, in which there is a fixed reserve ratio according to which the commercial banks multiply the money injected by the central banks. I will add a video link in the description which will help you understand the fractional reserve banking theory in depth if you wish to. But both these theories are not true. We will understand how really banks function. Whenever we deposit some money in the bank, it gets reflected in our bank account. So it is obvious to think that when we deposit our money at the bank, we are still the owner of that money and that the bank is merely holding the money on our behalf. But this is not true. In legal terms, there is no such thing as a bank deposit. In reality, when we deposit our money at the bank, we essentially give the money to the bank as a loan and the bank becomes the legal owner of the money. The amount which gets reflected in the bank statement is not the representation of our money which is in holding by the banks, but the bank's way of conveying the client that we owe you a given amount of money and that we will repay you this amount when you demand so. You will feel, so what? This must be another accounting complication which are in abundance in the field of finance. But this complication is a little special, as this complication has enabled the banks as the money creators in the economy. As we have established that what we see in a bank statement is the amount of money that the bank owes to the client, what happens when a person takes a loan from the bank? Suppose I sign on a legal document stating that I owe a person A a sum of rupees 1 crore. I am legally bound to pay Mr. A the money. Now there is no restriction for me on how much loans I can take and how much money I can owe to other people. It's up to the other person I am dealing with whether to believe my promise to pay or not. But I have no such restrictions to make such promises. Similarly, a bank can also make as many such promises as they wish. Whenever a bank gives a loan to a person, it does not transfer any money from some other place to his account. It simply credits the account of the person, which means that the bank has made a new promise to pay this person the sum of money mentioned in the loan agreement whenever he demands it in the future. Until now, we have established that the money we think we have in the banks is just a promise by the banks to pay the money when we demand it, and that the banks can create as many such promises as they wish. Then the million-dollar question is, how can such bank promises known as bank deposits, which can be created by commercial banks at will, can be used as money to facilitate the exchange of real goods and services in the economy? To answer this, we will have to understand a simple example. Suppose there are two friends, Arun and Varun. Arun runs a mobile store and Varun runs a clothing store. On day 1, Varun buys a mobile from Arun for Rs 10,000. On day 2, Arun buys clothes from Varun for Rs 9,000. So, on day 3, Varun pays Rs 1,000 to Arun and the dues are settled. The point to note over here is that on day 3, the dues were not settled in a way such that first Varun would pay Arun Rs 10,000 and then Arun would pay Varun Rs 9,000. Payment of Rs 9,000 got cancelled against each other and the dues were settled just by Varun paying Rs 1,000 to Arun. The function of money is to just facilitate the exchange of goods or services, and in this example, by just Rs 1,000, the participants were able to facilitate the exchange of goods worth Rs 19,000. This simple phenomena is used by the banks to facilitate the exchange of real goods and services in the economy with their promises or bank deposits. Let us now understand how commercial banks do so. Suppose there are two banks, Bank A and Bank B. P and Q are clients of Bank A and X and Y are clients of Bank B. P makes a payment to X for Rs 5,000 using his credit card. What this means is that P has instructed his Bank A to make payment to X on his behalf, and X has instructed his Bank B to receive the payment on his behalf. What this basically means is that Bank A is liable to pay Bank B Rs 5,000. On the same day, Q makes a payment to Y for Rs 7,000. Similarly, this means that Q has instructed his Bank B to make payment to Y on his behalf, and Y has instructed his Bank B to receive the payment on his behalf. So this basically means that Bank A is liable to pay Bank B Rs 7,000. So if we conclude the above two transactions, Bank A is liable to pay Bank B Rs 5,000 and Bank B is liable to pay Bank A Rs 7,000. The two transactions will get settled against each other, and on net basis, Bank B has to pay Bank A Rs 2,000. So like we saw in the previous example, if we observe the situation carefully, the banking system was able to facilitate transactions worth Rs 12,000 with just Rs 2,000. This was a very oversimplified example, but the basic principle behind how bank deposits can be used as money remains the same. During any day, a huge number of transactions take place between people who are clients of various banks, but the majority of the transactions get cancelled out with each other, and only a small amount of real money is required for settlement between the banks, which can facilitate a huge volume of transactions in the real economy. From the above discussion, it seems that banks can create money by themselves without any restrictions. Then the question is, what is the role of central banks and how do they control the money supply in the economy? The third type of money discussed earlier, central bank reserves, serves two very important purposes for the banks. First, as we saw in the example, banks need to frequently settle balances among themselves, and therefore lots of transactions also take place between the banks. Central bank reserves is the one used for interbank settlements. That is, central bank reserves is the medium of exchange for banks to transact with each other. Second, the currency in a wallets can be printed only by the central bank, and commercial banks can exchange their central bank reserves for this currency anytime. If a person has an amount deposited at the bank, he generally demands some of it as physical currency to use at the local stores, make small payments, etc. So the commercial banks have to also keep some central bank reserves so that they can exchange it with physical currency to meet the demand for it by the depositors. The central bank has a monopoly over the creation of these central bank reserves. Central bank reserves serve such important functions and are vital to the functioning of the banks. If the price of central bank reserves, that is, the interest rate to borrow these reserves, is low, the banks can give out more loans, and if the interest rate for these central bank reserves is higher, the banks have to limit their lending. And as commercial banks giving out loans is a major source of money creation in our today's economy, central banks influence the money supply in the economy and implement their monetary policies by controlling the supply of the central bank reserves. The central banks does so by something known as the open markets operation. I will link a video in the description which will explain the open market operations in great detail. If the central bank of an economy feels that the inflation is low, the economy is in slowdown and therefore decides that the money supply in the economy should increase, it decreases the price of central bank reserves, that is, the interest charged on borrowing these central bank reserves, which will in turn lead to increase in the money supply in the economy. Similarly, if the central bank feels that the inflation in the economy has increased a lot and the money supply in the economy should decrease, central banks increase the price, that is the interest charge on the central bank reserves, which in turn leads to decrease in the money supply in the economy. So this is how the banking system and the monetary systems function. The explanation I gave is massively oversimplified, but the basic principles remain the same. This system is crazy and has been deliberately made very complicated so that the general public doesn't understand what is going on behind the scenes. This system would have been very positive for the economy if bank lending and therefore money supply would have been used for productive lending to add value in the economy. If it was used for investment for production of real goods and services and in adapting new technologies, it would have made our lives more efficient and resourceful, and we would have had a stable economy with low inflation and low inequality. Sadly, it has not. Majority of the bank credit creation, along with hedge funds, is mainly being used for investments in financial instruments such as derivatives and equities in order to make superior returns. This is also the main reason behind the cycles of booms and busts which has now become a norm to happen in almost every decade. I have been doing research on this topic for quite some time and this is very fascinating. As it is said, valuations drive the financial markets in the long term and liquidity drives the market in the short term. I am on a quest to understand what are the fundamental principles behind the movement of various asset prices and how does banks and hedge funds use this money creation power to make superior returns in the financial markets. As and when my research proceeds, I will definitely share the updates and more insights on this topic with you all. In the description, I have added links to all the research papers, videos, and all the other sources I have used for conducting this research. If you are interested, you can check that out. You will find that very interesting. So all my dear thinkers, I hope you found this discussion insightful and useful. Please do press the like button and subscribe to the channel. Please do share the video with your friends who you might think will be interested in this topic. Thank you so much for watching. I will see you in the next one.